We are on the second video for section 20.1 and we're using the same information from some previous videos, so I've written this on the slide so we can use it for this example. This is the declining balance method, and it sometimes is considered an accelerated depreciation because it takes off more in the earlier years, and that's because we're using this percent on a larger value. And so we're using 150%, and the percents they usually give you are either 200%, 150%, or 125%. I occasionally have thrown in some other percent just to use for practice, but those are the three standard percents. Now we take our percent and divide it by the number of years for our useful life, which in this case is 4. And we get 37.50%. And as we multiply, we're just going to drop that 0. And on your calculator, it won't show you the 0. Our beginning book value is $16,000. And then we will take that for our first calculation, 16,000, and we're going to multiply that by our percent in decimal form, so we're going to change that to 0.375, and then we simply multiply. So when we multiply, we get $6,000, and you might notice that this is quite a bit more than some of the previous examples on year 1. And then we subtract 6,000 from 16,000, so now our car is worth $10,000 at the end of the second year. And remember, this is just based on this depreciation method. For year 2, we're going to use $10,000 and multiply that by our percent. So for year 2, our depreciation is $3,750, which would make sense because we're multiplying 10,000 here by the 37.375. Okay, so we subtract that from $10,000, and that leaves us a value of $6,250. On the next year, we're going to multiply by that 6,250. Once again, 0.375, and that would be $2,344. Remember, I am rounding every single time. So on each calculation, I look at my whatever my cents are, and if it's below 50 cents, then we're going to drop it. If it's 50 cents or more, we're going to add 1, and that's how I'm rounding these, just the normal standard way. I'm basically rounding to a whole dollar amount. Subtract the 2344 from the 6,250, and we get 3,906. And then we multiply that. 3,000. Oh gosh, I haven't even been using the dollar sign there. 3,906 times 0.375. Oh, here I wrote a 7, and that was really a 5. Who knows what I was looking at? So that's supposed to be a 5 there. And it is 2344 because I've calculated these previous to teaching you this. This is 1,465. Now, here's the thing. If I subtract 1,465 from 3,906, I go below my salvage value. Remember, this number has to be no lower than 3,400 because that was our salvage value. So what happens here is I have to recognize that. First of all, that's always the tricky part. If you take 3,906 and subtract 3,400, then you get 506. So we have to limit our last line of depreciation to $506 because we just can't go below. And remember, we find that by subtracting these two numbers, right? 3,906 minus 3,400 is the 506 when we subtract. So you just have to be careful there and don't don't go below your salvage value basically on this method or on any of the other methods except makers, because that's a whole different thing. Okay, so that's the end of that method, declining balance, and then we're going to look at some totals here. So this is just a chart that's showing all this information from the different methods that we used, and you can see that they vary a lot. On year one, notice that the amount that we depreciated was different in each example, and it changed according to the method we were using. And then also the book method year after year. The book value year after year, it was also different depending on the method. And so when a business is actually using depreciation, they're going to choose the one that they feel is the most useful for them for that particular year. Okay. So now we're going to jump into makers, which is our depreciation for federal income taxes. This is the basically the IRS way of depreciation, and we show you all of these different methods, and you can see there's all kinds of things you can depreciate. You can depreciate your racehorse, you can depreciate your dairy cattle, your bus, your copier, office equipment, and trucks. There are a number of things that can be depreciated, and you're going to see that on the charts coming up. Okay, so this is what MAKERS stands for. I can't ever remember this, so I just call it MAKERS, Modified Accelerated Cost Recovery System. And then our assets are classified by their useful life, and that's called the recovery period. So we don't really use useful life terminology for this method, but the recovery period is basically what we were using as useful life on our previous methods. Okay, so here's one of the charts. The first thing you have to do is take whatever your asset is and find it on the chart, and then which category does it fall in for our recovery period, right? Which is also known as our useful life. So you can see that the recovery periods go way out there. We don't do a lot of calculating with any of them except the first three, right? The 3, 5, and 7 years. And if you look at this, you can see on 3 years we have tractor units for use over the road, racehorse over 2 years old. So there's where the racehorse is. On the year 5 category, notice we have breeding cattle and dairy cattle and all kinds of other things. So lots of depreciation going on there. Then, okay, so you figure out the number of years for your recovery period. Then you go to the next chart and you find your percents based on that. Now, if your recovery period is 3 years, you actually do 4 calculations. If it's 5 years, you do 6 calculations. 7 years, you do 8 calculations, and so on. That's just how it works. Okay, so we find our item, then we go to the number of years to get the percents that we're going to use, and then we can fill out our chart based on that. We do not subtract salvage value, so salvage value does not come into play for this method. We go all the way to 0. We just multiply to find our annual depreciation. There is no salvage value. We depreciate to 0, and the recovery period is based on the IRS charts, and that's what we have to use. Okay. So we're still using this same example, right? We have the car for the salesperson, and that falls in the category of automobiles, and it's a 5-year recovery period. Now, we do not need some of the information, like this does not matter, right? We don't even look at that. That's not taken into consideration. So we just ignore the fact that it said we're going to use 4 years and a salvage value of 3,400. We don't use that for this method. And then these are the percents that we will use on the chart. You'll have to just kind of refer back to this as you work through this. If you print out my PowerPoint slides, hopefully it's side by side. Okay, so here we go. we start out with the same book value of $16,000. And an interesting thing on this, and I said this at some point, or it was in the notes, we use $16,000 to calculate every single one of these. So I'm just going to go ahead and write it in. This is just part of this that you have to remember. It's a little tricky because this isn't how we did the other examples. And that's because the percents add up to 100%. So we are going to get to 0 on this, and we have to use the actual book value where it started. Okay, so we multiply by our percents. The first percent was 20%, so that's just 0.2. And that gives us 3,200. We do subtract it from the 16,000, so our book value decreases. Remember, we are going to decrease all the way to 0. And then our next percent was 32%, so that's 0.32 in decimal form, which we always do when we're multiplying by a percent. So this year it's 5,120, and then we subtract that from the 12,800. That 800 just looks a little weird. Maybe it still does. And then we get 7,680. On the next year, we multiply by 19.2%, which is 0.192. And this year we will deduct $3,072. So now our book value is 4,608. Year 4 is 11.52%, so that's 0.1152. And in fact, year 5 is the same percent. So I'm just going to go ahead and write that out because we'll get the same answer for these 2 years, $1,843. And then we subtract, so on the first year, year 4, it will be 2,765. And then the next year will be 922. Year 6 is 0.0576. Remember, if you take the percents and add them up, you will get 100%. And this year, every once in a while, you'll be off by just $1 or so, and that just has to do with rounding. But you go ahead and deduct this full amount, 922, because we want our last amount to be 0. Okay. So I'll stop the video now. I have more examples to do. It may take one more video, it may take 2, and we'll go back and practice all the different methods. All right, that's it for now.